Good morning, everyone. Welcome to the Ankerstar Wealth Market Update. I'm Steve Ankerstar. I'll be your host today. Allison has the day off. Today, we're going to be talking how to assess and adjust risk in your portfolio, which is particularly important because of the turbulent times, volatile times that we've had so far in 2022 and likely to honestly continue to face for at least a little while before some of the problems that the economy is working through are digested. But if you are, when you think of this from a perspective of it's a little bit of inside baseball, kind of tells you what I'm doing, what other professionals are doing. And if you try to do this on your own, honestly, all you're doing is eyeballing it and you don't really have the math to back it up. But that's what I want to show you today. Before we begin, though, as a reminder, it's a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. All right, so let's take a look at the software program that I use. This is Riskalyze Pro. I'll share it out with you. And this is honestly exactly what I do. So when I first start talking to folks, I say, and this is Mr. and Mrs. example, I say, hey, send me your portfolio. I'll analyze it for you. So they send me their portfolio and I plug it in here and basically you enter the positions. And what you get is the initial analysis of the risk level that they're currently at. Up here, you can see in the upper left, that's a risk score of 60. It normally loads faster than that, so I'm going to refresh this. I don't know what's taking so long there. But for, sit down with a couple and you talk about risk, and moderately aggressive would be about a 60 or so. It looks like a speed limit sign. So therefore that's intentional. So I, as the advisor, for when I sit down Mr. and Mrs. example, they say, okay, a risk score of 60 is what we want. When you think of full market risk, that's a 75. So kind of like a speed limit 75. If they say my risk score is 60, then I have to design their portfolio to go up to, but not over 60, right? Because I don't want to be speeding in their portfolio and taking more risk than the clients want. So that's the purpose of this. So what you see here is a summary of the portfolio. In this case, it's a nominal 1.2 million. We'll kind of go to this point. You can see it over here, 1.2 million. Risk score is 60, the way it's been designed, which means this is a historical 3 sigma projection of the next 6 months. So this is kind of important. You say, okay, risk score of 60, so that's moderately aggressive. And I'm like, okay, well, those are words, right? So let's translate them into numbers. And that means, okay, in the next 6 months, this portfolio in a 95%, 3 sigma type environment could be down 12.4% basically, or up 20%. And a lot of people, when I hear percentages, are kind of, it's tough to imagine exactly the numbers. So you have the raw number beneath it. So that means this portfolio would go from 1.2, if it hit the downside projection there, it would lose $150,000. So that's a little different story when you start to say, okay, this, the next 6 months, this portfolio is designed, it could lose 150,000 and there, you might get a no way. It's like, okay, well, then we have to take some risk off, right? And anytime you really adjust the risk down, all you're doing is shrinking that window that you're looking at. Instead of from minus 12 to plus 20, you take some risk off and it would be like minus 8 to plus, 16 or something like that. I made those numbers up, but that's what you're really doing. You're shrinking your potential range of outcomes. And that's really what you need to have your mind around when you're in the portfolio or when you're investing is how much risk am I taking? If you're trying to beat the market, you have to be above 75 in the risk score to be able to do that. And of course, if you're above 75, when the market goes down, you're generally losing more than the market. So, you really have to kind of figure out what you're trying to do here. Are you trying to make money? Are you trying to protect money? Are you trying to live off your money? All of this software helps you kind of really get your brain around that. So you have your range up here. You have potential annual return is about 8%, which is where, the full market risk generally gets at 10 to 12%. It's not a straight line. It's wildly volatile, right? But that's what you kind of average over time. Excuse me. Dividend, this is not designed to produce that much in dividends. So therefore you're having 1.58% of 1.2 million. So you do the math. I'm not going to try it right now, but that's what you have coming in. The expense ratio for certain funds out there are some individual stocks, but like grid, cybersecurity, fixed income, opportunistic, those do have some expense ratios associated with them. So therefore this is a weighted average of the total ratio. So you're paying 0.35, but you're getting 1.58% out of your portfolio. Your basic allocation is down here. You're looking at about 70% stocks, 25% bonds, and then 5% cash. Now, in this case, cash happens to be municipal bonds, which are pretty much same as cash. But that's how you're set up. So it's very easy to kind of understand your allocation, your projected outcomes, and then you have a weighted average. You can tell this FIXD is 25% of this portfolio. The next holding, the clean energy ETF, is 8.75%. And you see the raw numbers, and then you see the percentages. That in itself doesn't tell you as much as clicking this risk reward heat map. And when you do that, you can see that each of these, you have your account risk at the top, and then you have each holding, and you can see the risk scores going down the side. So FIXD is investment grade bonds, right? So it's going to be right around a 23. Clean energy is going to be everything from Tesla to lithium battery companies to all kinds of things, right? And that's all obviously very high risk. The low beta, bond fund 47, G-bill, same as cash. That's 1, which is the lowest you can go. Artificial intelligence, robot, obviously you're going to have a lot of tech firms in there. So really, when you get in and look at all these scores, you're looking at a weighted average of the position size plus this, all that goes into a big math equation, which kicks out the risk score. Obviously, if you sold your 25% holding in bonds and bought Tesla stock, I'm not recommending that. I'm just saying if you did, your risk score is going to jump from 60 to like 77. That's a mathematical guess, but it's going to be a significant change from what could be, clicky on the app on Friday. And you just significantly adjusted your risk score because you saw a blip, Kramer's talking on CNBC, and you make a little adjustment in your portfolio. Okay, that's a big adjustment, but you still, over time, your risk can get out of control. And when the market's going up, you don't even notice it because you're making more money. You're slapping high fives. You're telling your buddies how awesome you are. But when markets turn, you have way more risk in there. And then you get, that outsized effect of the downside, which is not what you're looking for most people. So anyhow, that's how this is managed. Again, this is inside baseball. This is what I do. So each month we review every single portfolio and go through. We make sure the risk score hasn't drifted. There's a monitor on here that tells me if this moves 3 points either way, then automatically alerts me. So and then we go in and we adjust this. Or if a client says, hey, I want some Tesla stock, we go in here and we have to, it's like, okay, I can add Tesla for you, but what am I going to have to offset? What am I selling to offset that to add the Tesla? You have to kind of make some decisions behind the scenes. So that is very helpful as far as risk reward heat map. The scenarios often help people. It's like, people say, well, what's the worst that can happen? Well, the worst that it's not right now, it just seems bad. And CNBC is, of course, negative. So you can go in through some portfolios and you look at, here's your 75 portfolio, and here's your portfolio, the one we've designed for Mr. and Mrs. example. And the bull market, if in this case, 2013, right, our best bull market, 32% return, you would have made 21.5%. So you have to look at the client and say, okay, is that what you want, or do you want the 32% return? And if they say, okay, well, yeah, I'm happy with that because I understand the down, I'm mitigating the downside, but can you show that to me? Yes, I can. So let's talk the financial crisis. From peak to trough, it was a 53% sell-off. Right. So in that case, the market lost 53%. You would lose 33% if you were doing nothing. Obviously, there's changes that need to be made when things start going down, just like now in the market. I mean, there's changes that need to be made to be able to adjust risk to the downside and mitigate some of the losses. But if you did nothing, you're losing, a little more than half of what the overall market is losing. So, for those that are with me, most accounts are down in 2022, no doubt. But when somebody's like, hey, by performance, it's like, oh yeah, I'll talk performance all day because I can put, I can show you the S&P 500 and I can show you your account and you're losing less. And, I almost always say the same thing in the email or over the phone call. It's like, I'm not going to call you up and slap high fives because I'm losing less than the overall market. But yeah, absolutely. That is the goal in a down market. is, you're not going to flip the whole portfolio and start shorting stocks and do all that stuff, because that's insane levels of risk. But you are trying to lose less during the downturn, and then of course add new money to take advantage of the prices that are now lower than they have been in some time. So anyhow, that's really how you do all that as far as different holdings. So that's how you mathematically do it. I won't show you necessarily the rest of this, other than if you're a client of mine, you get these check-ins. These are automatically generated, so I'm not trying to, just because you get it at Tuesday night at midnight, I'm not, that's like not me seeking into your mind's eye at that exact moment in time, right? They're generated, right? So they go out automatically. If you respond, I'm gonna see what you say and then offer a meeting with you if you want to talk it through. So just be honest, respond, and then you're always going to get that follow-up email to say, hey, do you want to talk it out? And like, no, I'm good, sort of thing. Also, there's a retirement map. If you're not in retirement, if you're in retirement, then it's more of an income projection. But if you're not in retirement, you want to know like, hey, I've got like so much money and I'm saving this much per year, and it can kind of tell you your probability. And of course, the dark line is the assumption line that you put in. And then of course, the gray area is the range, the 3 sigma range of what actually could happen, right? So it's not saying, a lot of the online calculators give you an exact answer. It's like, well, really, it's kind of better to know what the Monte Carlo answer is, right, than the exact answer. But I just want to show you guys this. Last thing, excuse me, I will show you this morning is there are some different ETFs that you can use to mitigate the downside. I've just started using these. They're first trust products. You can see up at the top labeled, target outcome ETFs. This is going to be, you're going to see some of these, especially if I've worked with you for a while and I know that the downside needs to be limited. So for each of these, from BUFT all the way to BUFG, BUFR is my favorite, actually. That's what I'm using in most portfolios. These are a fund to fund. So it's a little bit like, hard to explain. But the fund has 10 to 12 funds inside of it, and those are actively managed, and those are levers that a portfolio manager can pull. And they're not trying to pick stocks or not trying to do any of that. They're simply trying to, as the market starts down, they are de-risking a portfolio using these 10 to 12 funds. And by doing that, is you're slowly reducing risk on the way down to make that soft landing, right? So right now the Nasdaq's down like 30%, S&P and Dow are down, 15 to 18, 19, maybe close to 20. And it's really, so if we started back in January and you were in BUFR, you'd be down about half of what the market is, right? Because it's going to take that out. If you're in BUFT, you're going to be down about a third of what the market is down, because it's de-risking it as it goes down. And then of course, when the market turns back higher, 2022, 2028, whenever it happens, that's a joke. It's going to come back. But when it turns back, then they start feeding back risk back in. It's all quantitative analysis. So it's based on math, just like Riskalyze is, to be able to really mitigate that downside and still get some of the upside capture. Right. So those are some funds you might see popping up in your portfolio. If you ever have any questions, ask away on what's going on. Or if you are not a client and you're interested in me taking a look at your portfolio, please, reach out, send it to me. I'll show you the math. Right. And, you decide if you're doing the right thing for you. But that's all we have for today's show. Thank you so much for listening in. I'm Steve Ankerstar, and we will see you back Monday.